Welcome to the Upside Journal Explainer. In 2026, domestic venture capital is struggling with extended exit timelines and dry powder gridlock. Yet, a sophisticated layer of cross-border diaspora business networks is quietly unlocking predictable counter-cyclical returns in AI and climate tech. Today, we're breaking down the hidden alpha traditional funds are missing. We're taking a highly clinical look at what's arguably the largest, least discussed drag on economic productivity in West Africa's largest economy. We're zeroing in on the specific mechanics of unlocking illiquid real estate asset classes in Nigeria. Because, look, this isn't just about real estate. It's literally about the foundation of capital allocation. Exactly. The economist Hernando de Soto really hit the nail on the head when he said, "The mystery of capital is tied to property rights. Without clear property rights, capital just gets stuck." And that's exactly what we're seeing right now. Today, we're going to systematically analyze an intelligence report on how archaic land administration infrastructure is severely obstructing credit velocity and stalling massive development across Nigeria. So here is our executive roadmap for this briefing. We've structured this into 4 distinct acts. First, the VC paradox of 2026. Second, asymmetric information and title verification. Third, the climate tech supply chain edge. And finally, we'll wrap up with the repeatable flywheel framework. All right, let's dive right into Act 1, the VC paradox of 2026. To understand this paradox, we've got to look at the macro landscape. On one hand, you've got this undeniable, massive liquidity potential sitting in African real estate. But on the other hand, there's a systemic lockup of that exact same capital, and it's driven entirely by an archaic land administration infrastructure. Just look at this staggering number. According to PwC estimates, Nigeria is sitting on up to $900 billion in dead capital. Yeah, $900 billion with a B. And that's just tied up in residential real estate and agricultural land. So we aren't talking about theoretical value here. This is physical wealth that currently sits inert, completely blocked from entering the formal financial system. Right, and to put that into perspective, the informal economy makes up a whopping 65% of Nigeria's GDP. But here is the kicker. About 95% of households lack uncontestable formal titles to their dwellings. Only 5% have them. Without those clear ownership records, these assets absolutely cannot be legally leveraged for bank financing, they can't be insured, they are completely locked out of the credit markets. Which brings us to Act 2, asymmetry and title perfection friction. So, how does this actually play out on the ground? Let's clinically define what we are talking about. Dead capital refers to real estate assets that are entirely cut off from leverage. You can't reliably use them as collateral, you can't insure them against title disputes, and you can't even tax them accurately, all because they lack legal property rights and formal registration. In Nigeria, the root of this issue goes straight back to the 1978 Land Use Act. This act created a centralized bottleneck, requiring explicit governor's consent just to formalize property rights, which, as you can imagine, completely stalls credit velocity. Breaking that down a bit further, the Land Use Act actually vests all urban land to state governors. Practically speaking, this means it's literally illegal to mortgage, sublease, or transfer possession of a property without getting explicit manual consent from the governor. It's a system where a rapidly growing dynamic economy is forcing every single formal land transaction through a highly centralized, paper-based bureaucratic choke point. Exactly. And to really grasp the sheer friction of these title perfection workflows, let's look at Lagos. Globally, Lagos ranks 184th for property registration. Why? Because to register a property, you have to navigate 12 distinct bureaucratic procedures. Then, you're looking at an average waiting period of 105 days. And the cost? You have to pay up to 11.1% of the total property value just in fees. So honestly, it's no surprise that 97% of land in Lagos is completely unregistered. The sheer cost and time of staying legal simply outweigh the benefits for most people. And the downstream effect here is what we call the institutional trust gap. Because the system is so fragmented and opaque, banks simply cannot rely on paper certificates of occupancy. If they can't efficiently verify a clean title, they're going to heavily discount that real estate collateral or just refuse it outright. For institutional capital allocators, this severely caps loan-to-value ratios, keeps formal registration totally financially unattractive, and directly suffocates multi-billion-dollar credit markets across the country. Now for Act 3, the climate tech supply chain edge. This is where the narrative really shifts. We're seeing proptech infrastructure and technological levers actively resolving these bottlenecks right now. Progressive subnational governments are driving a major modernization of property infrastructure. We're finally moving away from traditional manual registries, which, let's face it, are highly prone to fraud, duplication, and just missing paper files. Instead, we're shifting toward digital eGIS portals and blockchain-backed ledgers. States like Lagos are launching electronic geographic information systems to digitize the whole application process. We're talking about replacing centuries-old paperwork with immutable, tamper-proof ledgers, automated smart contracts, and e-certification. It's a massive upgrade. And we actually have the empirical data to prove this works. Look at northwestern Nigeria. The adoption of digital cadastral mapping and automated processing through systems like Kengis in Kono and KGIS in Kaduna has been nothing short of revolutionary. The research shows a 275 to 300% increase in registered properties compared to the old manual era. They implemented a streamlined 4-stage electronic registration process, and as a result, they've drastically reduced transaction times and really minimized fraud. But there is a critical physical dependency we have to talk about. And this is exactly where the climate tech supply chain edge comes into play. Factor analysis from these state deployments shows that power instability is the dominant latent challenge. To sustain these digital registries and maintain 24/7 server uptime, you absolutely must have dedicated physical power infrastructure. Consistent solar and inverter setups are mandatory here. The entire digital trust layer relies 100% on a stable, decentralized physical power layer. Right, and alongside that physical infrastructure, we are also seeing some rapid regulatory evolution. The Investments and Securities Act of 2025 is a real game changer. It establishes a firm legal foundation by classifying virtual real estate tokens as securities under SEC oversight. By integrating those blockchain ledgers with automated smart contracts, these tokenization initiatives in Lagos are establishing the high-trust environments that are absolutely necessary to attract serious institutional investment and cross-border deal flow. That brings us to Act 4, the repeatable flywheel framework. So, how do capital allocators actually execute in this environment? Well, we've synthesized all this data into a clinical operator's playbook for you. Here are the actionable directives. Number 1, you have to budget multi-month timelines for governor's consent. Structure your transaction financing to absorb those delays. 2, do not rely on a single source. Commission independent title searches at both the state and local government levels. 3, always prioritize properties with unbroken documentation chains over customary allocations. And 4, track state-level digitization progress very closely. A progressive subnational government digitizing their registry can materially change a transaction's risk profile practically overnight. And we know this playbook works because the data proves it. Pilot reform data demonstrates that when states actually digitize and streamline these exact procedures, transaction times absolutely plummet. Wait times for government land allocation and mortgage consent drop from hundreds of days to just a fraction of that. When you remove that friction, credit velocity increases proportionally, and you immediately turn dead capital into live, productive capital. It's a completely repeatable flywheel. So we'll leave you with a final thought to consider. As this digital trust infrastructure scales across West Africa, which state's digitized land registry is going to be the first to truly unlock the next multi-billion-dollar credit market? Capital has become highly commoditized, but the infrastructure to execute high-trust cross-border deal flow is rare. To get ahead of these macro signals and access our premium investor network, subscribe to the Upside Journal and join our membership communities. See you in the next Daily Drop.